Most sell calls you hear are driven by emotion. It's fear, it's scary headlines, or it's just short-term price swings. This one isn't. The stock we're talking about today isn't on the chopping block because something is broken or the business is failing. We're discussing it because the risk is no longer priced appropriately. The stock is NVIDIA, ticker NVDA. NVIDIA has become the undisputed face of the AI boom. It's admired, it's heavily owned, and it's deeply embedded in the market's favorite story. And that exact combination is why it's time to turn cautious. Let's start with valuation. NVIDIA is priced as if its current dominance will continue uninterrupted for years to come. The market is assuming sustained hypergrowth, constantly expanding margins, and near-perfect execution in a brutally competitive, fast-moving industry. That is an incredibly high bar for any company to clear, even one as exceptional as NVIDIA. Now, a high valuation alone doesn't guarantee a stock will fall. But what it does mean is that expectations are extreme. And when expectations are extreme, the margin for error completely disappears. Any small misstep could have an outsized impact. Now let's talk about competition, because this matters far more than most investors want to admit. NVIDIA is not operating in a vacuum. Every single major technology company now has a direct financial incentive to reduce its dependence on NVIDIA's chips. The big cloud providers are designing their own custom AI accelerators. Major customers are demanding better pricing. And NVIDIA's direct rivals are not sitting still. Companies like AMD and Intel are investing aggressively to close the performance gap, while the hyperscalers like Google and Amazon are pushing their own in-house solutions. Competition doesn't need to dethrone NVIDIA to hurt the stock. It only needs to slow that incredible growth rate or put a little pressure on those sky-high profit margins. When a stock is priced for absolute perfection, just slowing down is enough to cause problems. The next issue is the price action itself. Despite a generally strong market environment, NVDA has recently struggled to move meaningfully higher. It's not collapsing, but it's also not leading the charge anymore. That divergence matters. Leadership stocks usually confirm a bull market strength. When they stop doing that, it often signals exhaustion, not a new leg up. Markets rarely roll over all at once. They tend to stall out at the top first, and this could be a warning sign. Another major risk is what I call narrative saturation. Everyone knows the NVIDIA story. Everyone believes in the AI revolution. Everyone expects NVIDIA to continue its dominance. But when a story becomes universally accepted and believed, there's very little new demand left to drive prices higher. Who is left to buy? It doesn't mean the story is wrong. It just means it's fully priced into the stock. And fully priced stocks are fragile. Any news that isn't overwhelmingly positive can be treated as a negative. Let's be crystal clear. This is not a call that NVIDIA is a bad company. It's an amazing company. This is not a prediction of a crash tomorrow. And this is certainly not a rejection of AI as a powerful, long-term technological trend. This is a risk management decision. When a stock is this expensively valued, facing a clear rise in competition, is heavily owned by every fund, and is no longer outperforming the broader market, the smart move is often to trim your position or simply step aside, not chase the last bit of momentum. Selling here isn't about being a bear. It's about recognizing when the potential upside becomes limited and the potential downside becomes asymmetric. Sometimes the most important signal the market gives you isn't the hype and excitement. It's the quiet stagnation that happens under the weight of extreme expectations. Thanks for watching, and be sure to subscribe for more insights.